welcome to 2023 and our monthly real estate market update for the Phoenix metro area. We're going to begin with the impact that 30-year fixed mortgage rates have had on the 2022 market and what that might mean for 2023. As you may know, the 30-year fixed rate more than doubled over the course of the year, starting at 3.2% in January of 2022 and ending at 6.4% by December of 2022. This is an unprecedented increase. Let's look at the spread between the 30-year fixed mortgage rates and the 10-year Treasury yield. The spread has widened over the last year considerably. Looking back at the past 21 years, from 2000 to 2021, the average spread between the 10-year Treasury yield and the 30-year fixed mortgage rate was 1.79%. We see the average 10-year Treasury was 3.49%. So you take the Treasury, you add the 1.79%, and you get the average mortgage rate. This means that the average mortgage rate over that time period was around 5.28%. Over the last couple of years, that's fluctuated, but in the last year, we've seen that spread rise, where today the 10-year Treasury at 3.69%, the spread is 2.79%, giving mortgage rates of 6.48% as of this most recent posting from Freddie Mac. If that spread decreases, well, we would see lower mortgage rates. So if their spread were normal today, we'd see an interest rate of just under 5.5%. Basically, over the last year, that spread has widened to 2.79%, resulting in a record rise in mortgage rates. Another way to look at this is the spread is a measure of volatility and panic in the market. We've seen over the last few weeks that panic is starting to subside, which is good news for long-term interest rates. And it means that there's still a potential for rates to decrease even further. If we draw in an arrow, the first part of the year, we see folks getting more uncertain about the economy and panic entering into the equation in our world economically. And then around June of last year, the feds came out and said, hey, we don't have this under control. We want to reset the housing market. And we saw the panic go up again. And then at the end of this past year, we started to see the panic subsiding, and folks and experts, economists, and the Fed saying, well, maybe the peak of inflation is behind us. The bottom line here is there's still about a 1% difference between where that spread sits today and where it has been historically. Here are a couple of perspectives. The first one from Lawrence Young. The upcoming months should see a return of buyers as mortgage rates appear to have already peaked and have been coming down since mid-November. And from Dave Stevens, who's the former Assistant Secretary of Housing and who held positions at the MBA, said, so be advised this may be the one and only window for the next few years to get into a buyer's market. And remember, as Federal Reserve data shows, home prices will only go up and always recover from a recession, no matter how mild or severe. Long-term homeowners should view this market right now as a unique buying opportunity. So let's look at the forecast. First, the one thing that is true right now about forecasts for home prices is none of the experts agree. They go anywhere from depreciation of 5% to appreciation of 5%. What we don't see from any of these reputable forecasters is them calling for a free fall in prices in the housing market. Here's an interesting article from the Wall Street Journal where they looked at home price appreciation before the pandemic and after the pandemic. Pre-pandemic, from the fall of 2017 up until the spring of 2020, about 12% home price appreciation in that 2.5-year time span. The 2.5 years going into this fall, well, since the beginning of the pandemic, 38%. So it would make sense that in some markets and in some cases, we would see that adjustment of those high price appreciation. That would be expected. However, not a free fall in prices as some media headlines would suggest. Let's look at inventory. Lack of inventory was the headline for quite some time. Well, active listings over the past 2 years have grown. 2021 wrapped up with just about 450,000 active listings nationwide. The latest information for 2022, just about 750,000 listings. Also, pending listings have decreased every month since the beginning of last year. They were stable month over month from about February to March, but each month they then continued to trickle down. Pending listings, well, they're an indicator of velocity and demand in the market. So if there are fewer pending listings, that means there are fewer sales. So we have inventory increasing and we have pending or demand decreasing. And that means good news for buyers, both in what is available and flexibility in negotiating both terms and price. And there's no shortage of doom and gloom headlines like this from Diana Olick. Homeowners have lost 1.5 trillion in equity since May as home prices dropped. Now, this is coming from a Black Knight study. So factually, it's an accurate headline. Many might think, gosh, the housing market sounds like it's about to tank. Well, here's what that drop in equity put into perspective what it actually looks like. There's been a surge in tappable equity in the country. Tappable equity is until you get to about 80% loan to value. That last 20% doesn't even count in this scenario. This run up from 2020 to 2021 and even into 2022 gives a perspective. We are nowhere near where we were back in 2008 or the dip down during that time. Well, there were many forecasts of a tsunami of foreclosures, which foreclosures are a very important factor to keep an eye on. The industry analysis from MBA, here's what they have to say. For the second quarter in a row, the mortgage delinquency rate fell to its lowest level since the MBA survey began back in 1979. It declined to 3.45%. Foreclosure starts and loan and process foreclosures also dropped in the third quarter to levels further below their historical averages. As of the third quarter 2022, there have been 88,000 foreclosures nationwide. If you extend that out for a full year, that would end the year at about 120,000 to 125,000 foreclosures. To put that number into perspective, in 2019, there were 278,000 foreclosures, nowhere near what we were heading into at the start of the pandemic. Now, that's not to say that there aren't going to be people affected by the slowdown in the economy. Unfortunately, that happens in every market condition. However, the reality in delinquencies is that they're lower than what they have been in a very long time. And with high levels of tappable equity, homeowners have options to access their equity and move to the other side of any financial crises they might be facing. More often, headlines do more to terrify than to clarify what's actually going on.
And moving into our local numbers, these numbers are for Maricopa County. Let's take a look at what changes have occurred within the last year. Starting off with active listings in the under $300,000 price point, we went from 444 in January of 2022 to 1,251 in January of this year. The $300,000 to $600,000 price point went from 1982 in January 2022 up to 7,029 today. In the $600,000 to $800,000 price point, active listings went from 681 last year up to now 1,805. In the $800,000 to $1 million price point, active listings went from 229 up to 858. And last, in the 1 million and over price point, active listings went from 665 last year up to 1,664, so up almost 1,000. Moving on to the average sales price per square foot in the under $300,000 price point in January of 2022 was 210 and is now 205. In the $300,000 to $600,000 price point, it went from 250 January of last year to now 240. Not much has changed in the $600,000 to $800,000 price point. January of last year was at $275 a square foot and is now at $276. The $800,000 to $1 million price point went from $304 to $298. And the 1 million over went from $487 a square foot last year down to $473 a square foot this year. And on to average days on market. In the under $300,000 price point, January of last year, the average days on market was 30. Today it is 54. In the $300,000 to $600,000 price point, it went from 31 last year to now 76. $600,000 to $800,000 went from 45 last year to now 75. And the $800,000 to $1 million went from 43 up to 85. And last, in the 1 million and over price point, average days on market went from 59 up to 91. So what do these numbers tell us? Well, active listings being up from the peak of the market last year is great news for buyers. It means there are more options out there. They're more likely to get seller concessions and help with closing costs. So that is great news. Price per square foot has not drastically changed since the peak of the market last year. So that tells us that sellers still have really great appreciation in their homes. And days on market, while they are increasing, it is nothing to panic about. We are getting back into pre-pandemic real estate market territory. average days on market is anywhere from 55 to 75, which is what we're seeing today. So just an indicator that things are kind of shifting back into a normal market. Well, that concludes our January 2023 real estate market update. As always, if you have any questions or would like numbers in your specific area, please don't hesitate to reach out. We're always here to help. Thanks so much for tuning in, and we'll see you next month.